Welcome. Oh, wait, that shouldn't be there. There we go. That should be there. There we go. Much better. Ladies and gentlemen, welcome to Stock Dirty to Me. I am, of course, your host, Phil Better, the podcast mogul. With me, as always, are my smarter and better investors. You have Tony from the Stock Bros Podcast, who is an AMC bot, who loves the AMC so much. And then we have Dalton down below, the advisor from Banting Corp Capital Management. We are all admins in the group Stock Market for Beginners. We're doing this every week, usually on Sundays or Wednesdays, to give you guys an update on what's going on in the market and just answering your questions that we see in the group. So I'm going to start off. Tony, how has your week been? How are you doing? Has the market been fair to you?
Yeah, it's been pretty good. I would say the market's been on a steady, very, very slow and steady uptrending. It's basically, I know people think that nothing's happening and it seems like it's going up and down. But if you zoom out and you look at the big picture and you look at 2021 as a whole, the stock market index, the U.S. index, and the overall indexes like the S&P 500, the Dow Jones, and the NASDAQ have been trending up all year long, even though they've had their bumps along the way where they'll fall one week and go up the next week, fall one week, go up the next week, but they are all in positive territory. So for me, it's been a pretty decent year, pretty average year, I would say.
Excellent. And Dalt, how, being the residential license advisor here on the show, how is it going? How is everything, going good for you and your clients?
Yeah, it's going pretty good for me in the market. I'm not like most people, so my portfolio has been pretty much the same. I haven't added anything lately. I've been taking advantage of a couple option trades here and there, and I sold the stock. My whole position about a couple weeks ago. But other than that, I haven't added any shares in a while. My portfolio is as it has been, and just continues to trend higher. And yeah, I mean, S&P 500 is hitting a new high pretty much every week now, if not every week, every other week. It's been a really great market, a really stable market. My portfolio has been quiet for the most part and rising, so that's the way I like to see it. I don't like to see a lot of volatility or any of that craziness in my portfolio, at least.
Yeah, of course. Each portfolio is different, and your risk assessment obviously depends on that. Now, apparently, major news did get broken in our group, Tony, about something that huge news.
Yeah, huge.
And it is, of course, the AMC squeeze. One of the members of the group did let it slip when the big squeeze is coming or the short squeeze is going to happen. And coincidentally, it's a date that we probably won't forget because it is, of course, one of our friends' good date. But Tony, want to jump in and let us know what is the date and what should we know about the AMC squeeze that's going on?
So for those of you that are familiar with The Daily Show on Comedy Central, I'm going to play the role of Jon Stewart today. And I'm going to tell you that what we have some groundbreaking news. Apparently, AMC, it's going to squeeze on December 17th, guys. And it actually, in order for this squeeze to happen, it needs to break $70 per share. So if it does that, it's going right to the moon December 17th. So stay tuned and don't forget to hold with HODL until then.
And now, Dalt, I just want to know, what is the likelihood of this AMC squeeze happening? Now, as someone who knows nothing about the stock market or my limiting investment abilities, what is the AMC squeeze about? Is it going to be like the GMC squeeze, or is it going to be something else?
I have no idea.
Is it gave you definitive stats.
Is it going to be like the GME squeeze? No, it can never be like that. It can never be to that velocity because they just had simply way more shares short that they had to cover. They had to cover every share in the market plus an additional 18%. In the case of GME, they only have to cover 25% of the float here. It's not that big of a deal. If it were to squeeze, this is probably nobody has covered yet. But if it were to squeeze, it wouldn't go quite at the velocity as GME. GME was kind of people had to get out really, really quickly because of how many shares they had to cover. For example, right now in AMC, I mean, they got it at 25% of float shorted right now. So, I mean, even if they covered 5%, that increases their margin and lessens the pressure off that higher price. So they can really, do 2% here, 5% here, versus in GME, they couldn't really do 2% here or 5% here because they had to get every share back in the market and then do it over again, 18%. So they didn't really have the luxury of waiting around as long as short sellers can do here.
Well, that's because you are not talking about, and you're a shill because you refuse to mention naked shorts.
Oh, yes, the naked shorts, which seems to be popular with the AMC crowd. What is the naked short? I know we touched on it last meeting, but just a revamp, if you will, either one of you guys.
Well, according to AMC, the AMC themselves, they released a statement about 2 weeks ago saying that there is no evidence or there's no evidence or any credible proof of any existence of any naked shorts. They couldn't find any. They did an investigation. Make that of it what you will. I don't know. According to the people on Reddit, naked shorts are running rampant and over 100% of the stock is shorted. So I don't know.
Very interesting. So just to summarize what we talked about, AMC, the squeeze is happening on the 17th of December. It needs to hit at least $70. And our resident advisor, Dalt here, thinks because that the market isn't being, they're not covering as much, it won't be as volatile or as skyrocketing as GameStop. So take that as you will. Up, Tony.
Well, like Dalt said, GME was that's like a once in a lifetime thing. What happened with GME because
they'll never do that again.
They had over 100% of the shares shorted, which is insane. And the other thing to remember with GameStop is GameStop only had 50 million outstanding shares at that moment. So it was so easy to manipulate that stock. AMC has over 500 million outstanding shares, and seemingly every week they're issuing more shares. So they're diluting the market cap, and they're making it so that the float percentage is actually going to go down the more shares they issue. So it's going to be really difficult for that scenario to replicate itself with only 20% of the shares shorted. I think last time I looked, it was like 17%. So I don't know, make that of it what you will, but it seems impossible that we're going to see a GameStop 2.0. So.
Good to know. Now we're going to go into a little more, less speculative stocks, and we're going to jump into a question that we saw in the group when you were posting about the show. People want to know, is it a good time to buy bonds? Bonds seem to be safe, like we're always, obviously our residential advisor here. Yes. Would now be a good time to buy bonds, for your kids, maybe for the future? No. So if interest rates rise, existing bond prices are going to fall because new bonds coming on the market are going to be coming in at higher interest rates. So it'd be good to wait until after that happens, after interest rates rise, and then new competing bonds will come at slightly higher rates. I don't think rates have really differed much, though, from January till now. If you look at some of the corporate bond universe indexes, total bond universe indexes, which cover corporate bonds, some government bonds, other investment grade bonds. Last year in January, I think they may have been going for 2.3, 2.4%. Now they're hovering right around 2%. So it hasn't differed much, but I think that they'll probably go back up to 2.3 or 2.4. So it'd be good to wait, get a little bit higher yield, and you get some cheaper prices there once interest rates rise as well. If you're just looking at ETFs that track those total bond universes. Excellent. And Tony, do you have anything to add to the bond universe?
No. So he pretty much hit the head on the nail. I would say that bonds and stocks tend to, or bonds tend to do the opposite of stocks. So bonds are good for deflationary environments. So when we have like recessions and market crashes, because they tend to do the opposite of stocks. And you're just buying, when you're buying a bond, you're basically an IOU. You're loaning a corporation or municipal or government money, and then they're going to pay you back with some interest. So it's not like a stock where when you're buying a stock, you're buying a tiny piece of ownership in a company. That's not how a bond is. So I don't know. I think a lot of people might be confused about that. But yeah, bonds always have much lower return rates than stocks anyways. And if you're younger, if you're in your like 20s, 30s, or 40s, you probably really don't ever need bonds until you get close to retirement. So that it's like a way to hedge against the market crash, and you can protect your investment and all the money you've been contributing for decades. So it might be smarter to transition to bonds when you get older and closer to retirement. But for right now, you're just sacrificing gains by having too much bonds if you're young. So.
All right. Which you mentioned bonds fight against or do better in deflation. Right now, it looks like we're maybe going into maybe a bit of an inflation right now. Some of the market is worried. Should we be worried about inflation happening? What are some things that we can do to fight against it when we're looking at investing in the stock market, guys?
Well, I think it's important to understand what happened. So a lot of people are freaking out because the Federal Reserve of the Fed, they issued a statement that interest rates are going to rise in 2023, and it's a little higher than they expected. I believe that's what the article said, right? I didn't read the full article, but
I apologize. Neither did I.
No, I think it was they said they were going to raise it twice in that period of time. But I think it's important to understand what the Federal Reserve is, because a lot of people don't really know. The Federal Reserve is just a central banking system that's actually independent from they're supposed to be independent from the government. They're not controlled by the government. So they set monetary policies by regulating banks and banking policies. And they try to keep inflation in check, and they try to keep unemployment low. And inflation is just the decline of purchasing power over a period of time. So it's like when you create 25% of all the money ever existed in 1 year, obviously money isn't going to be as valuable anymore. So you're not going to have the same the dollar is not going to have the same purchasing power that it did 12 months ago. So that's something to be aware of when you're making decisions about buying a house or going to make a big decision, a big purchase. You should probably try to make sure you have your emergency funds in order, because the price of milk everything is going to be more expensive. So you just have to it's not like you have to be scared. You just have to be aware of what's happening, and it's probably going to be a very temporary thing. So you just have to be aware of what's going to happen. You have to make sure your finances are in order and invest wisely. So that's my take on it.
Dalt, anything you want to add to the inflation fear factor that may be going on right now?
Yeah, so inflation has been skyrocketing, and it is extremely high right now. Anybody that's doing their grocery shopping at say Walmart has noticed an extremely high jump in your bill. It's because because they gave everybody a whole lot of free money. Demand didn't really drop off as much as it should have under normal circumstances if we were to enter a recession or something like that. So the fact that demand has stayed so high for so long, and now as we open up and we get back to normal here, demand is back to even higher than we were before the pandemic last year. But the thing with supply from a lot of retailers, product suppliers, food manufacturers, is those supply chains have been pretty fragile, and supply hasn't been able to keep up with the demand. So there's some stuff that we usually shop for at Walmart that I haven't seen in weeks. Pam cooking spray, I haven't seen that in weeks. I don't know if you have it out there in Montreal, Phil, but we don't have it here in the GTA. So there's a lot of other. Yeah, go check, man, because we don't have it. We don't have it here at all. So there's a few other little household kitchen items that are just off the racks, and that's kind of what's leading to a lot of inflation right now. So that's a pretty transitory and short-term thing. As we move closer to the end of the year and supply picks back up, supply chains get to be where they were before, I think that we'll see inflation taper down, because you'll be getting a whole lot more products to the store, and you won't have that sort of demand outstripping supply, which we have right now, which is, I think, the major reason for the spike in inflation.
Awesome. We just got a great question here. Unfortunately, the name isn't popping up, but I am looking over on our screen here. It's Martha Gonzalez just asked. Yeah. So although inflation may cause our stock prices to rise, its true value has not been affected. Would this mean a correction should soon to follow? Is this a trend? Inflation equals stock increase, deflation equals stock decrease. Is that an accurate correlation, or is it the opposite true? Guys?
Can go both ways. Stock market can rise in inflation, and it can rise in deflation. If you think about it logically, inflation should be good for stocks. If money is losing value, and stocks are priced in terms of dollars, wouldn't that mean stocks have to move higher as well? So you could look at it. You could look at it both ways. The real wild card is what the Fed is going to do with monetary policy. I think that speaks a lot louder than what the rate of inflation is on CPI whenever those monthly reports come out. So Powell did say that he wants to keep rates unchanged until end of 2023. The funny thing with that is he's up for his term expires in February of next year. Is Biden going to keep on a Trump-elected Fed chair official? Probably not. So it doesn't really matter what Jerome Powell wants to do. He's certainly the bullish guy. That's Trump's pick, because he's very, very, very economic friendly and pro markets. But I think Biden moves to a more hawkish guy who wants to raise rates even faster than the end of 2023. So people are really applying a lot to what Powell is saying now, but he has to get reelected in February. And if he doesn't, well, we could be looking at totally different monetary policy from what the Fed is saying now, because he's only in charge for another few months, right?
Interesting. This brings me also, with inflation, it also brings us into the housing bubble that's going on right now. And one of the questions we got here was, will the housing bubble burst? Now, this would be kind of like maybe the second housing bubble to burst within our lifetime, at least my lifetime that I can remember. The first one being kind of the 2008 giant bubble burst there. I believe it's 2008. Was it 2008, the bubble burst?
Yeah. That was the junk bond.
The junk bond, housing market. Everybody lost their house pretty much.
Ninja loans, no income, no job or assets. Ninja.
There we go. Are we looking at something very similar to this coming? Is another housing bubble going to burst, or are we looking at something completely different?
Well, it's definitely gonna burst. I don't know if I'd say burst, but they're definitely gonna be a huge devaluation, maybe 10, 20, who knows how much, but prices can't stay like this. I mean, I've been trying to buy a house for a year now, and literally everything that I've bid on has sold for $25,000, $30,000, $40,000 over asking price. I just went to go look at a condo a couple days ago and was going to bid $15,000 over the asking price, and it ended up selling for $40,000 over asking price. So this can't keep continuing. And I think the one thing to remember when inflation is happening, or we're in an inflationary environment, is it's always good to invest in assets that are not duplicatable. So maybe I know the trend right now is like baseball cards and NFTs and stuff that you can't produce more of. I know like the rookie Michael Jordan cards and Wayne Gretzky cards have been selling at ridiculous rates in the past year, like $4 million. I think one of those cards just sold for.
Well, it is Wayne Gretzky, so it makes sense.
Well, and it's also not a duplicatable asset like cash, like money. We can just create money whenever we want. So when you can just create something whenever you want, it's worth less. So because it's not scarce, it's not rare. Anybody can get their hands on money. It's never been an easier time to make money nowadays. So I think it's wise to invest in assets that may not be duplicatable, and also stick to assets like S&P 500 funds or companies like blue chip companies that they're profitable companies. They've been through market downturns. They've been through recessions. They've been through the market crash and they've recovered, the housing crash and they recovered. If there was a crash, the worst or the last place I would want to own stock in is AMC or Sundial or companies like that, because I don't know that they're ever going to recover from that. So I just think that there's definitely going to be a housing correction at some point. It's just a matter of when. I mean, maybe, like you said, if Powell does get reelected, it may not happen until 2024. It may be 2-3 years from now. Who knows? But I think it's going to happen as soon as interest rates are raised and inflation goes up. I think that's when we're going to start seeing the housing prices fall. So,
Dalt, anything you want to add to that regarding the housing bubble being in Canada and our market's somewhat different from theirs?
Yeah, our market's a whole lot hotter. I know that you guys are valued, US is valued at 20% more than us, but we're having houses here sell for $100,000 to $300,000 over asking, depending on. Oh my god! Depending on a $500,000 house here is going for about $7,000 if you're anywhere in the GTA.
GTA, GTM, and GTV.
GTA, Greater Toronto area, Greater Montreal
area, and Greater Vancouver area. It started in Vancouver. Toronto started the market when Quebec decided to go, we want to separate. And then all the Anglos left and went to Toronto, which caused you guys to boost. And then with the influx from Asia into Vancouver, and the students buying up condos, the parents buying condos just for their students to live in, only like 6 months of the year, pretty much. The prices
you guys are getting hit harder than us then, because I know you were saying you were having shortages in what was it you were having shortage in?
Houses, period.
No.
The cooking spray. Yeah, little stuff around the house in the kitchen where we're running out of.
I haven't seen much of that. In the beginning of the pandemic, I saw a lot of that, but now I haven't really seen any shortages of anything. But it could just be my area too.
Yeah, it depends on the areas and the stores you go to, but yeah, our housing bubble didn't get hit as hard as you guys did in 2008 because we were somewhat different regulations, but it could be happening. We get ours in the coming years.
Can we take I want to ask the people that are watching or people that are going to be watching, leave a comment below if you're noticing any shortages at your local grocery stores, and let us know what your housing market around your area is, like how much your house is selling for, and let us know, are you trying to buy a house and any of the struggles you've been having. So
actually Martha again comes in with a great question. Again, I'm not sure why it's not showing your questions here, but why would inflation cause the housing market to fall? Wouldn't the selling price of a home also increase?
What was the question?
Why would inflation cause the housing market to fall or burst?
Who said that?
I don't think any one of us said that.
Oh yeah, you're right. She's right. It would cause the price of houses to rise. Yeah.
Well, we're talking about the interest rates rising too. Because when interest rates rising, the houses are going to become the more expensive to buy, because you're going to have a longer loan, or your loan is going to be a bigger loan in the long run. So
she apologizes. She may have misunderstood. It's fine. Sometimes we're throwing a lot at you guys, and of course sometimes.
I think she was talking about when, because when I said when the housing bubble may burst, and I said maybe after 2023, 2024, when they change their monetary policy. So maybe that's what she was thinking. So I might have misspoke. That might be my fault.
All right.
I was listening to a podcast the other day, and this was on the Futures Radio Show podcast that I listened to, and they had a guest on there who was used to work at the IMF, International Monetary Fund, and he was saying that housing builders they have been afraid over the last year to build more houses because they still have post-traumatic stress disorder from 2008. So they're building, and demand fell off a cliff, and they got stuck holding all these big bags of crap. So they said that they haven't been making that mistake this time around, and they've tapered off significantly. So what they're doing instead, they said there's still high demand, like we're at record demand for houses right now, but they've been building less, and they're just throwing the prices higher on existing homes that they have. Now, this is for new houses. I'm not talking about if you're buying an existing house that's 10 years old, 5 years old, or 2 years old, whatever. I'm talking about new builds, right? Because new builds, there is no bidding war. You pay what it is, right? So that's why prices of new houses have gone up. But they said that, or the guy was saying that as we move out of this, pandemic and people get back to work, these home builders will start to build more, which should put downward pressure on the prices of new houses. And I believe that's called the new home index. If you want to track the prices of new homes coming onto the market, those gains should slow and might even turn negative for new builds as they start to build more. And when they build more, they'll take the prices of those new houses down. Right now, they have them super high because they're only building a small amount because they don't want to build too much and get stuck in the same sort of situation that we were in 2008. So that will speak to new houses. For existing houses, I guess if the price drop in new houses is comparable to where existing homes in the existing home index are selling, you'll see people, why buy an existing home for 500 when I can buy a new house for 550, right? You might see demand sort of shift away from existing to new when that happens. So that will put a little bit of a cooling effect on the market.
So answering Tony's question about some of the houses, we do have a few people mentioning. We have Sherry Russell from Western Oklahoma saying you can get a spacious home for just, $250,000.
Amazing.
If you're looking, that's depending on how spacious you're talking about. But in Oklahoma, the land is pretty much probably ginormous plots of land you can get there. We have someone from Houston. Unfortunately, I don't have your name. I don't have it pulled up here, but they're saying they're going faster than they can build.
That's Martha again.
Yeah. Oh, Martha again. Yeah. I apologize, Martha. And then we have someone else agreeing with Martha. People are selling houses when they're on their way to look at them. So, which I would believe, because a lot of people have come into that money from proper investing or from side hustling or anything like that, and they're looking to, because we've been told our whole lives, buy a house. That's an asset that you want to have. So that's why we're seeing these houses maybe go up for more and more than they're actually asking for.
It's all about supply and demand, and right now it's crazy not to sell your house because
this is definitely a seller's market.
I mean, you're getting cash offers. I know so many people that are like, I'm going to put my house on the market. I wasn't going to sell, but if I can get $25,000-$30,000 over what I want, and my loan's already 70% paid off, I'm going to have all this equity. And but the problem with that is, where are you going to live after? Because now you got to buy something or rent, and even renting is really expensive. By the way, I have to put a caveat that I live in the 4th most expensive state in the United States to live in. I believe it was number 4. So we got.
I live in one of the cheapest metropolitan areas in Canada. I just want to say, but we are a major metropolitan. It's really weird.
So we got like Hawaii, California, New York, Massachusetts, and then Connecticut is right there. So, the cost of living is really high. And I think in Oklahoma, you can probably, that's why you can afford a really great house for $250,000, because the cost of living is so much less. In Connecticut, you can get a decent house for $250,000, but you're not going to be living in no mansion or anything like that.
You're not living in a spacious home in Oklahoma, is what you're saying.
Yeah, I mean, you could get a nice house for $250,000, but it's going to be like 3 bedrooms.
Isn't Connecticut like where all of the Wall Street guys live?
Connecticut's one of those weird states where we have like
it's like an hour to like downtown Manhattan or whatever.
Well, we have like 5 of the top poorest cities out of the top 50 in the U.S. But then we also have like 2 or 3 of the top 25 richest cities, like Greenwich. A lot of people move from New York to Greenwich, and they're buying up a lot of real estate in Connecticut because they're escaping from New York to get out of the city. So it's just driving up prices here. So yeah, the store,
I know there is a couple hedge fund managers. Paul Tudor Jones is one of them that lives in Greenwich.
Are you saying Greenwich is the suburb of Manhattan? Is what you're trying to say?
For the ultra rich, I think.
For the ultra rich,
Greenwich is
the
like
one who has the helicopters.
You could look it up, but I believe Greenwich is like easily top 20 like richest cities in the U.S. And they're really small too. So
now we're gonna just change a bit, going back to the market. Should people buy inverse ETFs? I have no idea what this is. Tony, you asked me to put this onto the show. Would you like to explain it to us, and then we'll get Dalt's opinion?
I can give you a quick synopsis on what it is. So a lot of them are like leveraged, meaning a lot of them are 3 times leveraged. So what it means is if the market goes down, anytime it works in reverse. So typically, in order for you to make money with an ETF, the ETF needs to go up in price. But with a leveraged ETF or an inverted ETF, it does the opposite of what the stock does. So a lot of people are betting that the ETF is going to fall in value and that there's going to be a market crash. So if you think there's going to be a market crash or it's going to fall in value, you buy an inverted ETF so that if it falls, you're actually going to make money and it goes up.
So it's kind of like a squeeze on a stock, if you will.
No, it just does the opposite.
Don't stop saying that.
Are we going to have an inverse squeeze, Tony? Is that what you're trying to tell us?
No. It just does the opposite of what the market's doing. So if people think that the market's going to fall, that ETF goes up rather. You know what I mean? It doesn't track what the market does. It does the opposite of it. So people do that to hedge their bet. If instead of selling off stocks, they'll just say, I'm going to buy an inverse ETF. So if the market does fall, I'll make my money back on that. But it's very risky. So
it's a risky investment. So similar to AMC, GME, and the meme stocks, pretty much.
I might not have explained that well. I'm sure Dalt can explain it much better. So I'll pass that over to him.
So. No, he did. You did a great job. So yeah, depending on which inverse ETF you're looking at, there's a bunch of them. They're either tracking a certain index that is inverse of the S&P 500 or Nasdaq 100 or Dow. But exactly as you said, if these major indexes were to fall, it would be taking the other side of it. So all inverse ETFs are on the way to zero. They're always on the way to zero. Intermittently, they skyrocket to, depending, again, let's use UVXI. It might skyrocket to 200, as it did last year or close to, and now it's been back on its way to zero. It's probably under 10 as we speak right now. And then it'll spike again. But they're always on their way down to zero. So it's not that you would hold them for the long term, because you'll definitely lose money. But you want to play them at certain times. Not you want to play them. Certain people who are extremely experienced in market timing, hedge fund managers and people that have been doing this much longer than any of us, use it to usually hedge their portfolio. I can't imagine anybody would ever take a position. Well, retail investors would take a position in that to try and profit from it, but it's usually used to try and hedge your existing long positions. For me though, I always use either options on on SPY or VU, or I would just use index futures and sell the S&P 500 directly. I don't like those inverse ETFs at all.
Well, aren't they 3 times leverage too? So they'll do 3 times. Are they?
Yeah,
all
usually
times?
Some of them are 2 and 3. I think they all are. Yeah, they all are.
So we do have
that could be very dangerous, because you could be doubling or tripling your losses if you're wrong. So that it's a very risky play. So that I could definitely see why you would do options instead.
So Martha,
and yeah, if you're early too. If you're early and you get in, you say, the market's going to drop, right? All this news, you get in, say UVXY is at 10, you're early and you end up losing 20%. Now UVXY drops to 8. And then at that point, you happen to be right. And now the UVXI skyrockets up to, say, who knows, 12 to 15, but you took that 20% loss first. So, like, again, you have to be there at the exact right time in order to make appropriate gain. That's why it's mostly used as a hedge, because market timing, it's super tough.
Okay, we do have a question. Two of them, I believe they're both from Martha Gonzalez. Where does the money come from to pay those that bet against the inverse ETF?
Ooh, that's a good question. That's a good question, Martha. Dalt, where does that money come from?
It comes from I think it's swaps. I think they have swaps on the leverage swaps on the individual indexes. And so how UVXY works is the underlying fund is always going short the particular index or the particular what's it called, index or fund that it's trying to track on the opposite side. So they're always going short that. So it's when that particular bet pays off, and it's all rolled over on a daily basis, I think. And whenever that particular day is that bet pays off, that fund manager makes money, and the fund goes up, and everybody in it makes money as well.
Okay, and Martha just asking again, just so that we know, ETFs, inverse ETFs, they have a different ticker. Okay, excellent. So you have to look out for that. I do want to just shout out to Sabrina and anybody else tuning in late who didn't get to watch the first half of the show. No worries. All you have to do is on the top of the group page, you go to the group, there is media. You click on the media and you can see all of the videos, the photos, and that have been posted. So you can go check out that. It's at the top, just below where you can invite your friends. There's a whole bunch of things. Just go to media and you can see the whole video from beginning to end and all the live videos that we've done on the show.
I would say to Martha too, I would say don't worry about inverse ETFs too much, because you're playing with fire there. That's a dangerous proposition to start buying those. And if you are buying those, you got to know when to get out quick, because it's a lot of guesswork. Trying to time the market it's so hard to do and nearly impossible. Just don't worry about the little crashes. And like today, the market dropped it was like over 1%, and then it ended the day only down like 0.25%. So you can't really freak out about these things, and it's all based on fear. So why does the market drop or go up and down? Is because of fear. So people see inflation. Oh my God, inflation. So people start selling some of their stocks and taking profits and putting it in their bank account because they're scared. More and more people are selling than buying, the market's going to drop. So, but that's also an opportunity for you to buy some stuff at a cheaper price. I wouldn't say go buy everything on a dip, but if you're buying ETFs, then sure, like a SPY or something like that. You want to make sure you're buying a company that's good quality and strong fundamentals. And also, I should say, I talked about Greenwich earlier, and you can take this with a grain of salt because I did a quick search on Wikipedia. The two zip codes in Greenwich, the average adjusted gross income in Greenwich, Connecticut. What do you think it is?
I don't want to take a guess because I don't want to be poor.
So there's two zip codes.
Over $1 million.
Probably,
no, not that high. So $638,000 and $721,000.
Well, I feel just
close. Sorry, I should have said $1 million Canadian, almost $1 million Canadian.
Yeah, Canadian. Yeah, he was talking Canadian. You have to correct us. We speak in Canadian.
Oh, right. I didn't do the conversion there. My bad.
Yeah, there we go. We are coming up to the end of this show. Remember, guys, we go live. No, what? Why is someone saying no? Sabrina, why are you saying no? I need to know why, Sabrina. You can have just
what?
Why is she going no? But ladies and gentlemen, we are coming to the end, so I'm going to give it off to first Tony to let us know where we can find him, how we can get more of his knowledge into our brains. Tony, care to share?
So I'm constantly scouring the forums, trying to help people out and make smart decisions. But you could follow me on the Stock Bros Podcast on YouTube. We'll put the link in the video description below. And I also, for all you new investors out there, we give a lot of information away for free, and I'm always open for helping people and answering questions. But if you want to learn the ABCs of investing and learn terminology and everything, you can check out my course on Udemy, and I could put that in there too. It's really cheap. It's a couple bucks, so I'm not trying to rip anybody off. So.
There we go. And your podcast is doing amazing. Just recently saw that it's in the top charts in what country was it that I see it? Well, give me a second here. Yeah, yours. I follow your chart.
I never check the charts.
I do. As a podcast promoter. Where are you? The Stock Bros. Yes, you. Unfortunately, yesterday you were in the top charts for the U.S., but now you don't rank. I apologize. You fell out of it. But moving on from podcasts, the Stock Bros, to panelists and financial tips. Dalt, where can we find you?
Yes, you can see where you can find me there. Rather than talk about where you can find me and what I do, I just have another point to go along with what Tony ended off with there. If you're going to speculate and you're going to try and go against the market, inverse ETFs, or you're speculating in stocks that are crappy, but you're trying to do a short-term swing trader or whatever, you have to make sure that before you start doing stuff like that your trade management is extremely good. You have to have stop losses, you have to have take profits, and it all has to be automated so that it removes any human emotion from it entirely. So for anybody that's receiving my option signals from being subscribed to the blog, as you can see, the last signal didn't do so well, but it was because I was able to get out early. So there was a 10% stop loss. If it comes to the 10%, I don't readjust it and let it fall further. It's 10% loss. It happens. It's the amount of, through the amount of trades, 6 out of every 10, I know that I'm going to win. So again, you're going to have some losers along the way, but trade management has to be good. So have stop losses, have take profits. If I'm asking for a 20 or 30% take profit, when it just gets there and it sells out, it's all automated. I don't have to worry about it. I don't have to have human emotion in it. We have a lot of people I know in the group that have huge gains, and you know who you are in companies that aren't going to be here 5 years from now, and you guys are holding on. You got to know when to take your gains. Otherwise, you'll make big amounts on paper, and they will stay on paper. So if you're going to speculate, make sure your trade management is good. Stop losses, take profits, everything is orchestrated before you get in, and nothing changes once you get in. I just have that to say.
100%. Always have an exit strategy so that you can always make that solid money, or you stop the money from flowing out. Again, ladies and gentlemen, I am Phil Better. He is Dalt. He is Tony. If you're interested in learning more about entrepreneurship, I host a podcast called Invest in Yourself, the Digital Entrepreneur Podcast, where I interview amazing entrepreneurs who have created businesses that you can sometime invest in. We just finished season 2, and season 3 starts next week. We finished off with Dom Einhorn, an amazing angel investor, startup, incubator, and amazing other stuff. He owns a rugby team. I talked with someone who owns a rugby team. How many people get to do that? Make sure you go check out investinyourselfpod.com.
We got to get him on the show.
Don't worry, I'm working on it. There's something coming in July. He's going to be for sure coming in July when I can't really talk about it, but there's some big things coming. Ladies and gentlemen, we are the Stock Dirty to Me podcast and live show. Thank you so much. Remember, if you have any questions, leave them in the comments when you're rewatching this, or ask us. We'll be more than happy to answer your questions on the show. And we just thank you so much.
Thanks, everybody.